Well, good morning, everyone. It's Thursday. It's November 14th. The market is not even open yet. That's why my monitors are off. There's nothing to report yet. I haven't even turned them on. It's only 8 a.m. here, Eastern time. Market's going to open up in about an hour and 27 minutes. I got up early today. My cats, I have kittens, and they keep meowing to open the door, so I get a sound at 5:30 in the morning. It goes, meow, 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 meow. It's hard to stay awake. And then they're so cute. You want to pet them, and the next thing you know, you can't sleep anymore. Anyway, welcome to my world. All right, something I want to go over with you. Important stuff. These are the two major issues that I'm seeing today. And you guys know me by now. I cut to the chase. I'm not going to, mess around with you. So, investors are cautious on lack of good news on trade talks with China. All right. The Fed Chairman Powell said he expects U.S. economy to keep growing at a solid pace. That's a problem. So we got China and Chairman Jerome Powell. Those are the two big issues that I want to talk about today. Now, as far as China, we're not seeing anything positive. Let me just back up here a little bit. Here, investors were wary after Wall Street Journal reported that Chinese negotiators were reluctant to commit to the size of purchase of U.S. farm goods in the interim agreement aiming at ending a tariff war. And then U.S. President Trump said last month Beijing would buy up to $50 billion worth of soybeans and other American farm goods. And they never confirmed it. So the way I'm seeing things right now, we're not seeing things moving in the positive direction. Stock market hasn't really done anything in about a week since it's been overbought, and since I told you guys that we're stretched out. And when I say stretched out, I mean stretched out. And I'm not going to get into why, because I've been into it just very quickly. If you look at the small caps, and again, I've been showing you guys this every morning. My theme has not changed. It's down. It was down yesterday. Small caps are already back in the range. Stock market has been helped substantially over the last month by this rally right here that you're seeing. But now the small caps are moving against the main trend. So right now you want to be defensive. As a matter of fact, gold moving higher, coming off oversold territory. Bonds, treasury bonds, the 30-year bond. I've been saying this for the last few days. Moving higher already a few days, coming off oversold territory. Time to be defensive. If you want to buy stocks right now, it's okay to buy stocks if you're going to be looking at utilities, which are moving up from pulling back. I think they're going to come right back up here. And consumer staples. I wouldn't do consumer discretionary. I wouldn't do technology. I would stay away from technology with a 10-foot pole right now. Why? Because the first sector that's going to eat it when there's no good news of a trade war will be technology. And the first sector that rise will be consumer staples and utilities. Why? Because people need toilet paper. People need soap. People need power. People need light. Energy. Necessities take over desires. Just really simple. I'm just breaking it down for you in the most simple way possible. I know I can talk about it for 10 hours, but ultimately, toilet paper is more important than a new toy from Amazon, than a new TV from Amazon that's made in China, or a new iPad. Toilet paper will always win. All right? Writing paper will always win. Lights will always win, every time and twice on Sunday. There's no question. You don't need to be a market genius to realize that. So consumer staples and utilities is where you want to put the money. Now, I want to show you something a little disturbing. And I'm going to go back to the bond market, and I'm going to go on a little rant here. I talked about this at length during my class yesterday, and I want to do it here. Now, I want to refresh your memory. Stock market's this is the bond market. Remember, when interest rates go down, bonds go up. When bonds go up, interest rates go down. They're inverse of each other. Right here, right around here, don't quote me on the exact moment, but right around here, stocks are at a 52-week high. Jerome Powell comes out and says, we're going to lower rates because we think in the future something bad may happen, global economy and so forth. They're being preemptive. Stock market was not preparing for it. We rallied hard. If you think the stock market is efficient, well, it took a month to get here, or let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Yeah, about 20 trading sessions is 1 month. So maybe 3.5 weeks to a month. So it didn't happen in a day. It took a month. I almost fell off my chair. I think I did fall off my chair. So my beef was this. Wait till the stock market's at a 52-week low before you lower rates, not at a high. So the stock market rallied, the bond market rallied. Doesn't usually happen at the same time. And then nothing happened. But here's something else. Then Jerome Powell, the market started coming back. The bond market started cooling off again, more fear about China. Jerome Powell says here, we're going to lower rates again. Bond market again rallies, stock market rallies with it. But notice the interest rates went lower than here. Remember, the higher we go here, the lower interest rates go. Interest rates went lower here than they were here. We took them further down. But what happened to the bond market? It didn't react. I mean, it reacted. Let's see. It reacted, but did it take out the high? No. And then something else happened about a week and a half ago. I'm not really good with time because I do this every day. So to me, a week, 10 days could seem alike. But, the Fed lowered rates again, I believe, last 7, 8 days ago. Well, interest rates went lower again. So theoretically, the bond market should have been up here because rates went low. Interest rates went lower, means bonds went higher. Then they went higher again. Then they went higher again. So in theory, bonds should be here, but they're not. They're here. So first time, they reacted. The public really thought it was going to save the day, right? Okay. Well, the second time they lowered rates, they kind of went up. And the third time, nothing happened. So how much powder, how much gunpowder does the Fed have now? How much power do they have if something bad happens to the stock market? We just had the Fed lower rates, and they just said that they'll lower rates again just yesterday. Look, let's talk about this. Meanwhile, Jerome Powell said he expects U.S. economy to keep growing at solid pace, but faces risks from slower global growth and trade tension. He didn't say it yesterday, but he said it at the minutes. I believe it was either 2 days ago or 3 days ago. He did say it. He said that if economy slows down further, we're going to lower rates. He said it. He didn't say it last night or this morning, but he did say it. He didn't close the door for lowering rates, not even close. All right. So, but here's my problem with this. The bond market, it's not reacting anymore. So you know how stocks go down, Fed says, hey, we're going to lower rates, and stocks jump up? Well, small caps, did they jump up over the last 5 days since the Fed lowered rates? No, they went down. Well, that's the small caps, you say, right? Well, let's look at large caps. How much did they go up? They went from here, from 307.50, 308 to, where are we now? 309.27. Yeah, that's a big move, right? 1.5 points. Fed just lowered rates this week. This is the stock market, folks. This is the stock market. Is this how the stock market reacts when the Fed lowered rates? Fed lowered rates and bonds went down. That's not good. So again, I'm not trying to scare you, and I'm not expecting a huge bear run here, but I am expecting the market, which remains overbought, to cool off. We're seeing narrowing of momentum. I talked about it yesterday. If you want to review that, look at yesterday's video. It's posted, and you'll see exactly what I'm talking about. But this isn't an ideal situation for the stock market because the Fed doesn't have any power to do anything right now. It's like the boy who cried wolf. It took less than a week, like 2 days. They lowered rates, and the bond market huffed and puffed for 2 days. So 3.5 weeks, a week and a half, 2 days. The Fed can't save the day. So what does that mean? Why is it so important? If the market starts coming down, and it will, what the Fed says is not going to be as relevant or as important as you could see by this. Yeah, powerful Fed. Here they had some juice. Here they had a little juice. Now it went down. So either China has to work things out with U.S., and if not, we don't have the Fed to help save the day anymore. We don't have them. Look, we need a catalyst big time. Otherwise, the market's going to cool off a little bit. Now, again, I'm not expecting a crash. I'm not expecting anything major to come down, but I'm expecting the market to cool off because the Fed's saying, don't worry, we'll lower rates. Don't worry, we'll be okay. It's not helping the market anymore. So what else do we got? What's our ace in the hole? China. Well, Trump said last month they would buy $50 billion. China did not confirm. Not good. All right. I've said enough. We're gonna have economic data in about. Let me show you what we're gonna have. We're gonna have jobless claims. Anything between 200,000, 220,000 is kosher. And then PPI, I believe PPI is going to be expected only at about 0.4, 0.3, 0.3. Yeah, anything below, say, 0 or even negative 0.1 and 0.4, that's a pretty wide range, is okay. I'm expecting it to be 0.2, 0.3. That's not a big factor. What is a big factor, and something that no one has began talking about, though, is, I want to show you something here. Growth in industrial production slowed 4.7%, but here, retail sale growth weakened to a 6-month low of 7.2% over a year earlier of 7.8%. So retail sales is slowing down slightly. Even if it's not slowing down, it's not expanding. That's huge. Why? The GDP, the quarterly GDP, 75% of it is retail sales. Retail sales is what causes that end of the year effect, and that's the sector that reports earnings last. So keep your eye out on retail sales. It could really put a damper on this market. It hasn't yet, but it could. But the numbers are not growing as fast as I would like them to see. Now, in light of everything we're seeing, all this drama with China, and it's okay. It's not that bad. And low interest rates, it's not that bad, but it's concerning me. And retail sales, 3/4 of our economy is based on retail sales. All right, I've said more than enough. The bond market's really concerning me because the Fed's actions are not having the desired impact on it anymore. And that leaves us in a position of vulnerability. I'll talk to you guys tomorrow. Have a good one.